is. Exactly how the upcoming housing crash is going to occur step by step. Because this is such a complex topic, I'm going to break it down into 7 really easy to follow and easy to understand steps. And if you get stuck or confused at any point, you don't understand something, just make a comment below and I will do my best to answer that question for you. So before we go and look into the future, we must first look to the past. So let me take you back. No, not that far back. I mean to the turn of the new millennium, the year 2000.
3, 2, 1, happy 2000!
Between the year 2000 and 2005, home prices across the USA grew by a staggering 50% in just 5 years. By 2005, 40% of all house purchases were as investments or second homes. 40%. And this, ladies and gentlemen, begins stage 1, where a house no longer becomes a home. Speculation from investors and, more importantly, REITs push house prices up in that area, forcing families out of the affordability range for many houses. REITs, if you don't know, are real estate investment trusts, and they only buy the best houses in the best areas, which therefore skyrockets the price and forces out a lot of good everyday families. Financial institutions in particular, and the majority driven by the shadow banking sector, which I'm a huge critic of, as many of you know. I really don't like the shadow banking sector, were responsible for most of these loans, which were on ARMs, which stands for adjustable rate mortgages. Not good mortgage products in my opinion. These are also known as variable rate mortgages in other countries outside of the US. The idea or the dream that was sold to people was that in 2 years' time, you could refinance your house and get a fantastic new introductory rate mortgage, and therefore release even more equity from your house. The con was that you could just keep doing this and using houses, which really are homes, as your cash cow to live the millionaire lifestyle. If you're enjoying this video so far, I'd really appreciate if you could click the like button below for me now. I really appreciate that. And why not subscribe to the channel while you're here? Doing this really helps this video to actually get ranked by YouTube. This was, of course, a huge lie, and this is where stage 2 began. The brokers got rich by selling these mortgage products to just about anyone. The banks then got rich by packaging up all of these mortgages and selling them as CDOs, which stands for collateralized debt obligations, which is basically packaging up all of these mortgages in a big bundle, some of them exceptional, some of them, well, crap, and then selling them to pretty much any financial institution or investment fund that would buy them, with a AAA rating, of course.
Can you name one time in the past year where you checked the tape and you didn't give the banks the AAA percentage they wanted?
If we don't work with them, they will go to our competitors. Not our fault, simply the way the world works.
CDOs were then rightfully outlawed. But you know, these crafty bankers, they came up with another way to recreate the CDO. They called it a BTO, a bespoke tranche opportunity. Very clever. If this wasn't crazy enough, banks then started to do swaps with other banks with these crappy bundles. These were called credit default swaps, and to save us getting too complicated here, because it really does get a lot more complicated than this, just think of it like playing blackjack. Yeah, it's a bit like gambling with your family home, so these bankers could buy $1,000 bottles of champagne at a strip club.
We had to buy champagne, and you ordered all the sides. Tell them about the sides you ordered.
The sides, so...
Sides?
Yeah.
Sides? $26,000 worth of sides?
Stage 3 was, of course, people living beyond their means and creating a bubble GDP. GDP is gross domestic product, which I won't go into now, otherwise it will overcomplicate the video. But this is basically all the goods and services that a country produces in a set amount of time. Some studies suggest that a crazy 50% of the country's GDP was as a direct result of the housing market. Stage 4 is where we go into crisis mode. In the 2008 crisis, this was caused by the shadow banking sector and holes on Wall Street. In this 2020 recession, this has been caused by a global virus. How a crisis comes about is irrelevant. The important thing is really how the central bank of each country deals with the crisis to overcome it. Okay, so the price of housing is predominantly affected and driven by two distinct points. Number one is the unemployment rate. The lower the unemployment rate, the more affordability people have because they have jobs, they can afford better housing, or more accurately, the payments, the monthly payment on a house. And the second point is interest rates. When you have high interest rates, less people can afford to buy a house. But when you have low interest rates, that means more people can get into the housing market and they can get more house for their monthly payment. This, of course, can also work in a bad way because when you have historically low interest rates like we have right now, people don't realize that historically interest rates have been double digits when it comes to housing, and eventually it will go back to double digits in the future, meaning some people in the very distant future could get into a lot of trouble. But right now we do have these low interest rates, meaning that more people can afford to buy a house. The lower the interest rate means that pretty much anybody can get into the housing market, assuming that the down payment is not too high and the credit score requirement is also not too high. Combine this with low unemployment, meaning people have a job and they can afford the monthly payment. Wait a second. Haven't all three of these points just reversed? Yeah, they have. So if these aren't warning bells for you, I don't know what are. There's also one other point that I need to address because it's very, very important and crucial with these other 2 points, and that is inventory level, which for simplicity, I'm just going to call this supply and demand. So here's an example for you. Why is a Lamborghini so valuable compared to, say, a Ford? Well, the Lamborghini is in very short supply. They don't make many of them compared to a Ford, which they are just coming off the assembly line non-stop all day long. So you have more of a supply of Fords, meaning the price is a lot lower than a Lamborghini. The same principle applies to the housing market. Too many houses on the market, just like the Ford cars, and the price comes right down. But when you don't have enough houses on the market like the Lamborghini, the prices go up. This is supply and demand in the housing market. And take a wild guess at where we are in this principle right now. Yep, we don't have enough houses on the market. We have very low inventory, meaning that the prices are being pushed up. Stage 5 then takes us into the realm of high unemployment, signaling the start of the recessionary cycle. What is the recessionary cycle, you may ask? Well, it means high unemployment, meaning job losses and wage cuts, where we are right now. And because people have less money, there's then a lesser demand for products and services in the marketplace. When there's a lesser demand, prices have to go down to meet that new demand from the marketplace. You of course have other competition, so this causes a constraint in the business community, meaning that some businesses will go out of business, meaning more unemployment, meaning that this creates a downward negative spiral. More unemployment leads to more unemployment. It's just an ongoing cycle. If you just look at this graph, you can see that we're already 50% over the peak of the unemployment rate from the 2008 recession. With high unemployment comes financial hardship, such as missed mortgage and rent payments. We also have something called unemployment scarring, which is where a percentage of those jobs lost during a recession simply never come back again. Despite the Fed's best efforts, unemployment remained high right throughout the 2008 crisis, and I expect it to do the same again during this crisis. Stage 6 is always the central bank to the rescue. During the 2008 crisis, the Fed's weapons of choice were as follows. Number 1, interest rate cuts. This is the most powerful weapon that any central bank has. It is like bringing out the big guns, and during the 2008 crisis, the Fed were able to slash rates right down close to zero. What this does, it stimulates the economy. It allows business owners and people in general to borrow money very cheaply, and therefore stimulating the economy.